My name is Ndwiga Kamwangi. I work for Cooperative Bank. I head retail and business banking credit. This flat rate and reducing rate. Now, flat rate, in very simple terms, the interest is paid on the entire principal evenly. So you calculate the interest on day one and you spread it to the tenure of the loan. Now, whether you pay that loan quickly or you go to the end of the loan of the tenure, you still pay the total interest. Now, reducing balance is different. It is calculated monthly on the remaining balance of the loan. That means if you have reduced the loan, the following month your interest will be the same rate, for example, but a lower amount because it's based on a new balance. Now, normally, flat rates are quoted as lower than reducing balance. So a businessman needs to be very careful. You don't look at the quoted rate. You go look at how much am I paying for this facility. You will realize in almost all cases, you pay more on the flat rate than on the reducing balance. Now, flat rate has its advantages. If the tenure is short, then you go right from day one knowing this is the much I will pay and I finish. But whenever the tenure is long, and long, I mean in relation to the accounting period, or even in relation to your business cycle. If, for example, I would say for many businesses that we support, if the rate, the tenure is more than 6 months, we recommend you go reducing balance. In deciding whether to take a loan on flat rate or on reducing balance, the customer needs to first look at absolute amount they will have paid if they go as per schedule. You realize that even though flat rate is quoted lower, you may end up paying more. Now, the second thing you need to look at before you make that decision is what is the possibility of the rate going up. Because the good thing with flat rate, once agreed, it won't change. But reducing balance in most cases will be varying according to the market. So if there's a chance of the rate going up and maybe surpassing the flat, then you go by flat. And the last thing I would give a business as a tip to consider is the tenure of the facility. The shorter the tenure, the more the predictability of rates, especially if they are reducing and variable. Fixed is fixed, but the longer you go into the future, the fixed flat rates tend to be more expensive because you calculate interest on day one, even though on the last day the principal will be much less.